So I am revealing to you a strategy that will basically allow you to get entry in the market at any point in time at all and make a lot of money. What is going on, guys? It's KOJOFOREX, aka GBP Emperor, aka Emperor of Blues. In today's video, I'm going to show you a tricky but more efficient scalping strategy that has allowed me to literally take my phone and trade on the market like I'm playing a video game. And what I'm going to show you is basically very simple, but it requires you to put in a lot of work. It requires you to be very attentive, and it requires you to watch the video to the very end to basically grasp what I'm trying to share with you. And once you grasp it, you cannot unsee it. So without wasting any much time at all, because this is a very short but precise video, let's dive right into the chart and I'll break that scalping strategy down for you to understand. Yeah, guys, so you can understand that when you come to the market, almost always you have a strategy that you're using to trade. Either you're trading the sniper entry strategy or from the ghost strategy that I teach you guys all the time, trying to catch that entry from the very bottom or at the very top. Or sometimes you're trying to catch an entry based on some moving average or some smart money concept where you're waiting for some order block and stuff like that. But the real question lies with the fact that what if the market has already traded above your demand zone, your supply zone, or the market is not anywhere close to your order block? How are you then going to find entry? Would you just sit down, waste all the time waiting for the market to stall and continue trading while you're seeing and counting all of these pips passing you by before you make an entry? That's how come I developed that strategy where I'm like, rather than wait all while for the market to get to a particular zone or entry, there's an easy way that I can be able to catch the market and make some small profit along the way while I wait for it to get to my important zones. So that is what we are looking at. Now, guys, look at this. You remember that when it comes to like my entry strategies, I've taught you guys so many things, right? Which is like, let's say, for instance, we're waiting for the market in a prime zone, right? Let's use the chart of GBP USD, right? You can see that I've marked this zone here. For instance, I would normally wait for the market to reverse, back up, trade zone, higher, low, get to this zone, print some formations in this zone, and then once I see my candle confirmations, then I'll be interested in going short. Likewise, the same for when the market is going on the downtrend, right? It's making lower high, lower lows. I'd wait for the market to get to a key zone, right? Let's say, for instance, we're talking about this zone here. The market gets to this zone, then I would also now monitor exactly what it is doing here, and then take my entry. And then I've taught you that of the trend line and the Fibonacci and so many other lessons that you've learned here. But like I said, in today's strategy is more focused on what if the market has already left your zone and is continuing to another zone, right? So for instance, let's use a simple analogy from GBP card, right? So if you look at this GBP card, you can see that it created this high here, right? Now, if I zoom in to the daily time frame, you can see exactly where it hit before reversing, right? You can see that it tapped exactly on this resistance region, right? Or short volatility range, and then started selling off, right? Now, normally when I come to the 4-hour time frame, you would want to find your entry within this range, right? You'd want to find your entry within this range. Once you find your entry here, you're targeting the market to come to the most immediate low, which in this case would be this very low right here, right? Now, what I'm trying to teach you now is that let's say the market got to this point and then you're supposed to find your entry here, right? Because that is like the market printing the bearish signals and giving you all the signs and signals that is going to actually sell off from here. So you want to jump in here, put your stop loss beneath the range like this, and then start expecting that the market will trickle down to this very demand zone or long volatility range, right? Now, as you're expecting this market to play on a setup like this, what if you actually missed that setup, right? And then you probably came to meet the market somewhere here. Does that mean you're not going to take the trade anymore? Or you probably even came to meet the market after this next move right here, right? You can see how I'm printing the candle. Does that mean you're not going to jump in on the market anymore? That is basically what this concept is about, which is like basically when you miss a move, how you can still jump in on the market from any zone at all, right? Now, if you take a deeper look at this, normally what I'll do is that overall, I'm already thinking that this market literally hits that supply region or resistance region, and is obviously selling off after printing the confirmation. So I have already identified my next possible zone where this market is coming to, which is this zone right here. Now that I've identified this zone, then all I am doing is that I'm literally expecting the market to trade all the way into this zone, right? And then for risk management sake, I'm supposed to take my entry within this range so that I can put my stop loss right above the range, which is going to minimize my risk or loss when the market goes sour. But here I'm saying that, okay, I missed the move. Maybe I was so busy like reading a book, watching a movie, going out, or in a meeting, and I came to meet this. What am I still going to do? What you can do is that, number one, you must follow some key principles. Identify the trend of the market. Make sure that it has hit a previous support or resistance range, or long volatility or short volatility range. And then the third option is that you know where it is going. So once you're able to identify that, okay, I have seen this, it has fulfilled all the rules, but I know where this market is going, and where it's going is this next support region, next long volatility range, then I want to trade in the direction of the market. So many people have been trained, especially beginner traders, to psych their mind to almost expect a reversal in the market. They see the market going in a direction, they're trying to like buy against the trend. Once you start psyching your mind in that way, you're already a loser in the market. You must always follow the trend. Go along with the trend. It's so hard, but simply a very basic principle that everybody needs to follow. Thinking about the fact that you just must program your mind to go with the trend. And once you psych your mind that way, you can never unsee that, and you would always print money in the market. You wouldn't even need to do any analysis anymore. So looking at this, what I would just do is that if I come to see the market this way, I'm still already thinking, okay, we're in a downtrend, we're going short. How can I jump in on this? Let's say I came to meet the market right here. All I'm going to do is that I'm going to find my entry. Normally, I'd want to prefer an entry after a closure of a candle. So in terms of that, then that meant that I'd have probably even entered here. Right after this closure of this 4-hour candle, you're going to see me put my stop loss, my entry right here, and my stop loss. This is where it's important. Now, you cannot put the stop loss above the range like I always teach you guys, which is here, because at that point, you're going to obviously risk insane amount of stop loss. It's like 100 pips. It's not prudent at all. What you want to do is that once you find the closure, what you want to do is you want to put your entry right above that closure. So in this case, we're going to be risking about 25 pips, 27 pips ish, right, with a stop loss like that. And then what you're still doing is that regardless, you're still expecting the market to come into this low. That's if you want to hold it for a swing position. But if you're scalping, then you want to look for any wick beneath that range and then just scalp along in that direction like that. So in this case, we'll probably expect the market to come to this tiny bit of wick here, right, which is like a minor reversal range for the market, not a major turning point, right? And then we see how the market plays out. So here you can see that the market will instantly put you in profit because you're scalping, right? You're just selling. Make sure that obviously you're using a small account or a risk-adjusted account that you can always recover, or you don't have so much feelings attached to it when the market even goes against you. Because remember, it's literally a scalping strategy. You sell into this, once the market makes you some money, you can choose to instantly close. Or you can perhaps be more conservative and then expect more pips to go in your direction. So here you can see that straight away, the market will hit your take profit, right? Now, it doesn't end there, right? Look, what you can do is that you can keep entering in this market, right, at any closure of the market, right? So you can see here, let's say we entered first one here and then the market closed here, right? What can we do? After this closure, we can also add another tiny bit of an entry here, right? And then what do we expect? We see another closure like this, right? You can see that here, another huge candle. So imagine that you had your first entry here, scalp multiple positions here, and then you waited for 4 hour, it closed, another 4 hour came here. And you can see that all this we're doing it in the middle of the range. And where is the middle of the range? The middle of the range is from this zone right here to this next support region, right? So within this range, so many people don't trade on the market. It's very sad, but a very critical one, because this is the fluidity of the market. That range is where volatility is happening, where volume is actually taking place in the market. So you cannot miss to not be part of that moment in the market. But that's when mostly we get people say, oh, I missed the move, I cannot jump in again. Oh, the market moved, and you're literally watching and you say, shit, I came to literally see the market here, and suddenly it's running 2,000 pips, 100 pips, 50 pips, 500 pips, and you're just sitting there idle with your hands in between your legs, waiting like a dead chicken. You understand what I mean? So with that, you don't want to miss out on such a move. You want to make sure you're milking a little bit of it. Even if it's just like 20 pips, 30 pips, 50 pips you cut out of it, you're going to be fulfilled. You're going to feel a little bit happy. You're going to not be angry and anxious about the fact that I just missed this move and look at how it's far. Because you understand what I'm teaching you, which is like following that principle of waiting for the closure, jumping in and put your stop loss right above that candle. Let the candle be that guard, and you can make money along the way. And I, like I've said, explain this to be a literally a scalping strategy. You don't want to see it anything more than a scalping strategy. And I've used this so many times. I can show you so many accounts that I've used the same concept to literally trade. When you see this one, right, you can see that from here on, the market just goes right into profit. And so by then you would have made a lot of money already, right? And then subsequently, we've seen that this market has just been trading sideways, right? In a situation where you have like a sideways market, right, you are likely possibly going to have like a huge drawdown, right, in this type of strategy, because number one, you're trading a continuation. And what the market is fond of doing is that anytime it's trading a continuation, there's going to be that one opposing candle that goes in the opposite direction of the directional movement of the market overall, and then suddenly just continues with a strong momentum. So you want to do this on a very precautionary notice, and again, like I said, don't expose yourself to too much risk. But once you master this, there's no going back. You can always just look at the market and trade like a game. And I've done this, and I'm going to shoot more content like this to even go deeper. And I'm also going to do a live practical one like this, right? No analysis, just watch the market. Okay, it's going bullish, let's just buy into it. Okay, it's going bearish, let's just sell into it. And we're going to make money live, and I'll show you guys like that. So if you love this content, you know what to do. We are back on YouTube for real. Smash the like button, subscribe to this channel if you haven't done that. Connect with me on all social media, KOJOFOREX. Click in the link in the description to join the KOJOFOREX Telegram community if you haven't done that already. And I'll see you guys in the next one. Peace.